Hi, this is Scott Murray, and welcome to the Daily Economic Market Chat for Tuesday, January 24th, 2023. It's great having you with me here today, and we're going to talk about flash PMIs. We got those out of Europe, a mixed bag. Yes, we're seeing elements of improvement there that actually might help the U.S. economy. Export demand, that's been a weak area. We've seen it moving a little bit better lately, and maybe European downturn will not be as severe as expected. And what's helping? Fuel, weather, those things have really helped out. Hard to predict as an economist, but weather does have these effects, and it's especially on the inflation side of the equation, impacting now to the positive than we've seen to the negative, helping supply chain. And we see services in Germany doing a little bit better. At the same time, manufacturing is bettering in France. Net, just a slight improvement with the composites, but yes, seeing at least one component in each country in expansion territory is a relief. We've seen that weakness. Not so good news out of the UK. There we see all sides of the equation falling. Manufacturing, which has really been on a lower element at 45, coming up near 47. That's an improvement, but still the weakness on the service side of the equation. Net, 24-month low. Yes, pricing power is easing. Yes, we're seeing some improvements in inflation there also, but the core demand element in the UK continues to be quite weak, and they struggle through that. We'll jump around to Asia. There we actually see better numbers, composite moving over 50 there, to almost 51. We've seen some services continuing to do well. It actually even moved higher to 52 from 51. However, and manufacturing, a little bit of an improvement, but not much there. So these yield curves that have been put in place to improve the inflation and lowering the inflation has actually kind of worked a little bit for the service side of the equation. We still think that they may increase the curve there to 75 basis points versus 50, potentially even up to 1 there. Lots of bank purchases helping out right now. Estimate for the first 20 days of January, we've seen 15.4 trillion in purchases versus the previous record, which was in October at 11.4. So the government is working hard, using the yield curve to sort of help the inflation area, but also you're making purchases to stimulate their economy. So working better. Not so good news out of Asia. There we see continued weakness. This is the 4th straight month of contraction. We hadn't seen that. Excuse me. The Australian economy had been very resilient for years, really benefiting from its close relationship to the China economy. Here, since the pandemic, we had seen roughly 5 declines before these previous 4 that I mentioned, so making a net total of 9. In the previous period, what we saw was the worst was 3, and then we had just minor little downturns, but they quickly turned around. This does not happen this time, 4 in a row, and you can see how the China economy is then impacting Australia, something to keep our eyes on. We know New Zealand is also struggling a little bit, and potentially a change in leadership as we look towards the end of the year. Leading indicators, which we talked about yesterday, really forecast, but we did get positive news domestically out of the Philly Fed, moving back up to 7, negative territory still, but off the 17 that we've seen drop before. So Fed readings have been a little bit challenging in terms of looking at the economy in real time. We've gotten some mixed readings over there, but clearly, as we talked previously, leading indicators pointing to the south, maybe even an early pullback. Maybe that actually might be helpful as we set the stage for the next expansion. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.